Welcome to Big Picture. My today's guest is Hiren Ved, and with Hiren we would be analyzing, dissecting that what only his market thought is, where he is excited about investing money, where he feels there is a combination of both growth and value. We are staring at a market where you got two ends: one, technology, and second, value stroke cyclical comeback. Now rarely that happens. Growth and value rarely moves together. Now technology stocks are high growth stocks, but they are expensive. Cyclical stocks are cheap, but they've been underperformers. Technology stocks are overowned, but cyclical stocks are underowned. So can you really have what fund managers say a barbell approach? And what is the best way to navigate in this kind of a market where markets frankly are not giving you any chance to enter? You have to take a decision which perhaps may not be very conducive if you're waiting for a good entry price. Hiren, fantastic to have you back and welcome to the Big Picture. It's a pleasure to have you, as the co-anchor of Big Picture today. Now, before we get into specifics of the companies you like and why you like them, let's understand the market setup. Markets are refusing to come down despite what is happening on ground. If you do any yardstick, auto sales, FMCG sales, what is happening to capital goods, all the indicators are suggesting that the second wave will have an impact on demand, sentiment, and also output. How come markets are not recognizing that?
Well, good morning, Nikunj, and thanks for having me on the show. I think similar questions were asked during the during the first COVID crisis, right? And the markets, after the initial crack, climbed every wall of worry. But as we all know, markets are forward-looking, and markets understand that the current impact of the COVID crisis is relatively not repeatable, right? So it's like when you see a big provision number in any company's P&L, and if you understand that it is one time, you recognize it, but you don't pay too much attention because you know that it's not going to repeat again and again. And I think it's the same thing with markets. People understand that this disruption is relatively short to medium term. And if you look at the post-pandemic era, then actually there is a reasonably bright future ahead of us. Secondly, I think the answer to that question that one should ask is that why is it that in the midst of a pandemic, the Indian corporate sector has delivered very strong margins, very strong profit growth, and from Q2 of last year, we've seen consistent upgrades in the Nifty earnings in general. And now we are starting to see even the breadth of earnings revision beyond just the Nifty stocks. And I think the reason is that COVID became an inflection point for many corporates to completely rejig their businesses, reduce their cost structure, improve productivity, because there was no visibility when first time COVID hit us. And therefore corporates had to respond to that very aggressively, and they went into survival mode. And I think that it is the phenomenal capability of the top 200 companies, I would say, to manage margins and the business amidst this situation is what is being reflected in the markets, in my opinion. So markets are forward-looking. Earnings have surprised on the upside, despite what we would have thought in the early phase of COVID. And I think the second phase of COVID is, companies have realized how to manage the situation from the experience of the first lockdown. And therefore, I think that markets are willing to overlook this. And in fact, companies which are most impacted, their stocks are actually doing better than companies which are relatively less impacted. So the markets are telling us something that, we are not concerned about what's happening in the short to medium term, and we are willing to look forward.
It's a fair point, Hiren, but for an investor, what is on the table? Are we in a market where markets are pricing in a lot of growth and a lot of comeback, not only for FY22 but for FY23? Because in the second wave, markets have hardly corrected, unlike the second wave when the market got bombed out. So while markets may be right in doing a positive and a constructive forward-looking assessment of the economy and earnings, are stock markets pricing that in, which means for investors now, the headroom to make money could be perhaps limited?
I think partly you're right, Nikunj, that, if the markets are bringing forward the recovery and already, in many stocks, we are starting to discount not just the current year FY22, but even FY23. It is quite possible that in some segments of the market, because you're discounting a lot of things in advance, there will come a phase where markets may consolidate because you're bringing forward those returns today. But having said that, we need to understand that markets don't only think 22, 23. There are the market looks much ahead, right? And therefore, just like nobody expected what the numbers could be in 22, do we really know what the numbers are going to be in 23? They could surprise upwards or they could be as per expectations. We don't really know. And therefore, the trick is that the markets will always adjust as things go along. And in my view, again, something very similar that happened during the first crisis might happen, which is that initially the estimates for recovery were very low. Then as we lifted the lockdowns, we saw a V-shaped recovery in the economy. So everybody took their GDP forecast up. Now again, in the second wave, people have taken their forecast down. And I won't be surprised that come October, November, December, hopefully as we get vaccinated, people will again take back their, growth can surprise on the upside. So we do not really know for sure if predictability of FY23 numbers was so perfect and accurate. And I don't think anybody has got, any year perfect for the last several years. There could be surprises on the store, in store. And I think it's not just about 22 and 23. It's about the confidence that we should have. Are we starting a new economic growth cycle in India? And my feeling is that, yes, we are probably onto something where we are starting a new economic growth cycle. There will be fits and starts in between. Yes, it doesn't mean the markets will keep running away. It may happen that maybe the Nifty at some point in time consolidates, corrects, and stays in a range, but the rest of the market catches up. I mean, there are scores and scores of sectors and companies which are breaking out of, long years of consolidation and downturn. So let's not look at markets only from the prism of Nifty. And I think that's the big mistake that many investors are doing today. When I talk to a lot of them, they look at the Nifty and say, oh, markets have gone to 16,000 or 15,000, nearing about 16,000. Let me book some profits. I don't want to enter the markets at this stage. I think that's a big, big fallacy. You've got to start looking beyond the Nifty. And I think what happens is that there are certain experiences that we have near term which stay with us, right? And this is very similar to what happened in 08-09. The scars of a deep correction always remain for a longer period of time. And you keep feeling that the markets bounce back too fast, too quickly. and I look like a fool if I enter the markets, at these levels.
Okay, and the two themes which we are bullish on, and they both are perhaps different ends of the spectrum. One is cyclical, and the second one is platform. So one side, your view is that you should invest in companies which are disruptive in nature, which are high growth companies, and which are doing something different. But on the other hand, you are also of the view that you should go and buy businesses which are part of the old economy basket and which could benefit if the economy is coming back. Aren't they both very contradictory strategies?
No, they're not contradictory. I think they are complementary. I think, um, you know, for some time now, I think the big picture theme that we have is that everything that is digital and cyclical is likely to do well. Digital because I think the digital trends anyway were taking hold. We know that, we are seeing more and more digital transactions happening. Every business is growing digital. There was this whole onslaught of e-commerce that came into this country. And those trends were secular trends. But COVID accelerated that trend dramatically at a global scale, right? And I think, therefore, it's a big trend that we cannot miss when it comes to our investment thesis. And therefore, we are very, very clear and bullish on IT services, the entire internet cohort, platform companies, which is all part of the digital theme, where they are using technology and the internet to accelerate growth. And many of these businesses, while we keep debating GDP shrunk, GDP up 8%, 10%, but many of these companies are growing at 30, 40, 50%, right? I mean, online brokers have added 8 to 10 million new accounts. They've been growing at 50, 60%. Many internet companies, delivery companies, right, are growing at much faster than what GDP is growing. And that is all being enabled by technology. Our IT services companies, the big companies, were growing at 5-6% dollar revenue growth. They're all talking about double-digit dollar revenue growth. You just had the AGM of TCS, where Mr. Chandrasekhar has again reiterated that we are entering a new structural, digital cycle globally in technology. So I think we ought to recognize that. I think it is still underappreciated. People move from quarter to quarter, but I think it's a much bigger trend. On the other hand of the spectrum, I think that what we've seen is that some of the sectors which went through a very severe leverage cycle, whether it is metals, power, infrastructure, that entire cohort, including, in my opinion, auto ancillary, because the auto industry also went through even pre-COVID, they weren't doing well. They went through a lot of headwinds. And I think a lot of that is now likely to become tailwinds, right? So whether it is capital goods, whether it is metals, whether it is autos, whether it is auto ancillaries, that entire cyclical is just a very broad word. But I think that there is huge opportunity there to make money. And in my opinion, I think that if you look at whether it is earnings surprises, whether it is better cash flow metrics, whether it is incremental return on capital, whether it is deleveraging, all of that, by and large, all the financial metrics that we look for, is improving. And I think that incrementally from here, it is much likely that you will find many candidates in the cyclical end of the spectrum where you can not only get earnings growth and revival and earnings surprises, but also a P multiple expansion, which is very hard, in my opinion, for us to now get in some of the companies where all the capital was flowing in. That doesn't mean those are bad companies. They are great businesses, but they may not be great stocks for you to make money over at least the near term. I think that market moves a lot on incremental rate of change. And I think the incremental rate of change and improvement is far better in the economy oriented sectors, the cyclical sectors, than it is with the defensive or the kind of companies that have done phenomenally well. And that doesn't mean because you're buying cyclicals, you're buying bad companies. There are extremely well-run companies with great management teams, which are on the cyclical side as well. It's just that the macro environment was not good for them. Now the macro environment is becoming favorable. I think we will see the private investment cycle pick up. And when I speak to some of the CEOs of capital goods companies, they are telling me that after many, many years, they are seeing order books come back. 8, 9 years, they've never seen this kind of an order book situation. That tells you that the momentum in these businesses is coming back. And also understand one thing that, markets tell you something. So when these stocks are going up, I think the market's giving you a message. It's up to us whether we want to pick up that message or not.
Okay, we'll be discussing two companies. One is JSPL and the second is ICICI Direct. I want to start with the latter first. ICICI Sec. Why do you like it? Because the brokerage business is a highly competitive business. A Zerodha company, Zerodha has disrupted the entire model, and we know the commission structures are coming down. What makes you bullish in this space where there is A, drop in realizations, B, a lot of disruption which is also happening because of the startups now?
So, Nikunj, what happens is that any industry which gets disrupted, there is always a disruptor that comes in and takes away a part of the market share in that industry, right? But what we've also seen is that there are a few incumbent players who also adapt reasonably well, right? And I think if you see the online brokerage industry, you will see that a Zerodha came and it disrupted the industry. Just like, for example, Tesla came and disrupted the entire automotive industry. But that doesn't mean that Tesla is going to have all of the 100% market share, or even a 50% or even a 25% market share of the automotive industry. Yeah, you come, you knock at the door, you disrupt the industry for a while. You quickly take away 2, 3, 4, 5, up to maybe 10% market share of that business. But there is always some existing incumbent players who are equally dynamic, who can adapt to the situation. And they have please understand, they have certain strengths, right? So let's say, for example, an ICICI Securities, I think it's a company which has adapted phenomenally well to the challenges to the sector, right? What advantages do they have? They already have clients. They have a whole banking platform behind them. They've always been digitally ahead. They are investing more in digital capabilities, right? They have the ability to cross-sell. They have the advisory knowledge that exists within the ecosystem. And I think that with all the other advantages that a typical incumbent has, they've been able to transcend this challenge that the new startup technology players have put in place and adapt to the situation. And it can be seen in their numbers as well. I mean, they are also adding, I think last month they added 100,000 plus new accounts. And obviously there will be new players, there will be more competition. But I think that many of these platform companies some of them at least will respond very well. And those who don't respond will fall by the wayside. I mean, that's the nature of the beast, right? I mean, it's the survival of the fittest. But in every industry that you see which gets disrupted, the disruptor obviously gets some market share, but many of the incumbents, some of them retool themselves, reimagine their business, adapt very well, and then grow, along with the opportunity set that is available. And I think ISEC, I would believe, is amongst one of those which has adapted reasonably well.
Will join us, but right now it's the management of JSPL, Mr. VR Sharma. And the way we would do is that I perhaps would lead in with a question and then Hiren can follow after that. Mr. Sharma, fantastic to have you back. Thank you for being part of the big picture. Hiren is also with us today. Now, before I throw it open to Mr. Ved, I want to first understand from you that last time steel companies considered a price hike was about 15 days ago. What has been the acceptability after that, and do you think another one is coming in the month of July?
Yeah, good morning. We have to understand that from where these prices are going and how, what is the total mechanism. First of all, the international spot market demand is extremely superb. America is the biggest driver today, consuming steel at a price of $17 to $1,800 a ton, followed by China, that is about $1,100 a ton, and then rest of the world ranging from $950 to $1,050 a ton. Europe, very surprisingly, is also importing day night, and this has also led to the overall raw materials and minerals prices going up. So the coking coal prices have gone up, iron ore prices have gone up, the scrap prices have gone up. If you see the last from October 2020 till now, the scrap has gone up by $280 a ton, and the iron ore has doubled, and so are the other metallics like pig iron, HBI, DRI. So everything is gone up. So the major driver is America as of now, and the major contributor in a way is basically the government-driven projects worldwide and the stimulus packages declared by different governments.
Mr. Sharma, commodity is nothing else but a function of demand and supply. Last 10 years have been terrible, horrible and pathetic for the steel sector in India. Big players have suffered and smaller players did not have the appetite to add on. How much more do you think there is going to be this demand-supply gap before fresh capacity will kick in? Because fresh capacity, sir, will kick in. What we need to understand when and how soon?
You see, during this lockdown, if you see last 14 months' time, the world has lost more than $50 trillion of economy. The world is having more than $100 trillion. Out of that $50 trillion, the world has lost. Now, to recoup and recover this, everybody wants to be in a different league and different pace. Now, the steel consumption worldwide has outperformed the production. So the production is less, the steel consumption is very high. So we used to consume about 1.6 billion tons steel in the universe, and today the demand is 1.75 billion tons. So there is a net shortage of 150 million tons. The country produces, India produces only 110 million tons maximum. And you can imagine if the second largest steel producer in the world produces only 110 million, then the demand supply gap is too wide. So the steel plants take a lot of time to commission and to come on the production. It takes about, in Indian conditions, if it is a greenfield project, it takes about 5 to 7 years time to start a new plant. So today we have 135 million ton of capacity available, but utilization is only 110 million ton because of the resources are not there. And finally, India needs to go to 300 million ton overall steel production and consumption by 2030. So the gap is very wide. Gap is 165 million ton. That means 16 or 17 plants of 10 million ton each are required to be installed in this country, or the existing players will have to double their capacities so that by 2025 or 2026 we reach to allow about 170, 180 million ton. So overall, I would say this demand is going to sustain, and the stimulus packages being declared by the countries like US and Europe and also China, they will keep on pulling the material. And the iron ore prices are going up everywhere. You have seen that in India, the iron ore price has gone up by 200% in the last 7 months' time. So all these factors cumulatively is pushing everything towards a very a different cycle, and I would not say it is super cycle, but it's the ultra super cycle which we are facing, and we have to all have to be a part of it. And finally, the aim is that the world should recover the lost $50 trillion in next 2 years' time. So I feel that next 2 years are going to be a good super cycle, and I think this is what your question was.
Yeah. Yeah. Hi. Good morning, Mr. Sharma. It's great to have you here, and I'll use this opportunity to tap into your experience. I think from an investor perspective, one of the things that people fear about is that all the noise today, all the talk in the steel industry is purely based on higher prices. But do you think that structurally there will be volume growth in India? And also, if you could give some understanding, because again, at the back of the mind, there is a fear that China is a big unknown, right? Can China turn on the supply tap? They have taken a few steps recently to cool off prices. So how do you think China balances on one hand decarbonization, and on the other hand, they want to cool off raw material, iron ore prices and steel prices? And therefore, do you think that there is some predictability that is there in the way China deals with its steel industry? Your thoughts on this would be very, very valuable, because that's always at the top of the mind. So two things. One is your assessment of volume growth beyond prices. Because all the discussion on steel is always revolving around price and price hikes. And secondly, how do you see China responding to this, dual objectives of decarbonization and managing inflation?
Yeah, I'll reply one by one. Three major questions you have asked. First of all, I'll take China. During pandemic time, say December 2019, and then January 2020 and February 2020, China reached to a level of about 70 or 75 million ton per month. But they had a very V-shaped recovery in the month of March, and they reached to 85 million ton in March, 95 million ton in April, and 100 million plus in May. And thereafter, they did not look back. Last year, we did a lot of business with China, and not only JSPL, but the entire steel industry. And we supplied steel to China, semi-finished as well as finished. And also we supplied steel to the customers of China, like in Southeast Asia, Middle East, Africa, and also in Europe. So that means China was not exporting. And today also China is not exporting. If you see overall, China exports about 100 million ton steel a year. This is including in the form of machinery. So this 100 million ton out of 1.1 billion ton, that is 1100 ton, is just a very small amount. And today China is exporting hardly at the rate of 50 million ton per year. So first of all, we can compete as Indian industry. We can compete China today anywhere in the world in terms of prices. Number two, our prices today, I will tell my price in JSPL. We have taken a very different kind of stand, that we will keep our prices at least by 15 to 20% lower than the spot market price in the world. So today we are selling and we are exporting in the spot market in the world at a price of $1,000 plus a ton. That is about 75,000 rupees per ton. And our domestic prices are hovering around, ranging from 52,000 rupees a ton to 58,000 rupees a ton. And few of the products we have about 64,000 rupees a ton. So if you see the on and average, the price gap is about $200 a ton today. So this $200 a ton make us always competitive, that no other steel mill in the world can export to India. And the Indian customers will be happy to buy from the Indian suppliers. So similarly, the other steel industry, they are also maintaining a particular gap, but I do not know how much. But in our case, we are maintaining this. The other is the demand versus production. We in JSPL in 2 financial years, we have increased our production by 36%. This is a record, 36%. No company in the world could increase the capacity by 36% without adding any capex. So without adding any capex, we reached a 36% increase in 2 years' time cumulatively. And we have come to a level of 7,500 crores of PAT in the last financial year. We were in loss 2 years back. And this all has happened in this pandemic time. So rightly said by Honorable Prime Minister once that during pandemic, you can always find the opportunities. And this is what we discussed, pondered last year when on 22nd March, the lockdown was declared. Mr. Naveen Jindal, he himself said with us, we have a very fantastic team. We found that what is to be done and we made a roadmap. And that roadmap is helping us today also. So over and above, the incentive is given by the world economies by declaring the stimulus packages, which.
Okay. Really appreciate your time, Mr. Sharma. I'm afraid we'll have to interrupt you there. Just conscious about at 10 o'clock we need to take a break. Hiren, while Mr. Vijay Chandok of ICICI Security joins us, let me address Hiren, the investor here. And I must say, Hiren, the way you're asking questions, sometimes I feel scared. I'm an anchor, professionally trained.
I'm losing the voice.
Okay, I think Hiren didn't get my question there. Never mind. No, Hiren, I'm saying the way you're asking smart questions now, I feel threatened, even though I'm an anchor, professionally trained.
No, Nikunj, I don't intend to take over your job. I have a handful here. But I think it's quite interesting the kind of answers he gave gives us the confidence that this cycle has a lot of legs to run.
Hiren, as an investor, you have to sell before the steel cycle peaks out. So how would you take the decision to sell steel stocks? You've explained us very nicely in terms of the demand supply equation, but buying a commodity or a steel stock is like you renting these stocks for a trade. You will keep them for 12 months to 18 months. When will you take the decision to sell them? Will it be based on steel cycle or will it be based on price?
So Nikunj, I think that when you invest in these kind of cyclical stocks, it is very important that you understand. First of all, you should believe that this cycle is much longer than what people expect it to be, right? So in our opinion, there is definitely enough, cycles. There will be mini cycles within a big cycle. And let me give you an example. I mean, usually we all say that we don't invest in cyclical businesses, very commodity kind of businesses. But there are times when you can see that, the cycle could be much longer than what you expect it to be, right? And, I've been talking to not just analysts in India, but global analysts who've been tracking this sector for 20, 30 years now. They've been doing this in and out. And I think every metric that you see, the very fact that, decarbonization is a big trend globally, climate change is a big trend globally. We also know that every country has done a massive fiscal stimulus. And I think India also, forget anything else, India itself has to build out a lot of infrastructure. I think there is reasonable confidence that we have that this cycle will last much longer. In fact, we did invest in Tata Steel in the previous cycle. I think it was in 2002 or 3, and I still remember Mr. Muthuraman was the MD. He had done a great job of making Tata Steel very competitive. It was the lowest cost producer of steel in the world. And they kept an analyst meet in Taj, and there were hardly 14, 15 analysts who came to attend the meeting, right? And everything was there in front of us, but people had biases, from the previous cycle, and we invested and we held on to the stock for at least 3 to 4 years before we decided to go out. So I think I don't think that it is very easy for global capacity to come back. I think demand supply gap is reasonably large. I think raw material prices are rising. And yes, you have to be very, very alert as to when you want to, get off the horse. But I still believe that people are hugely underinvested in this area. If you look at the mutual funds, if you look at portfolios of companies, stocks like Tata Steel or Hindalco or JSPL, you will not find too many of them invested in this. So I think trying to find the top of this cycle or to find the top is still in my assessment still time. There is still time to do that. So people haven't even started yet. People are just too overwhelmed with the kind of rise that they have seen, and I think there is still opportunity. But you are absolutely right. When you invest in these businesses, you have to be at the top of what is happening around the world. But we believe that this cycle is probably here to stay for much longer than what most people think it to be.
Okay. Mr. Vijay Chandok joins us now, Managing Director and CEO with ICICI Securities. Vijay, fantastic to have you back. Thank you for joining us, Vijay.
Thank you.
We are discussing with Hiren on how the entire financial platform stroke the entire financial intermediary space is changing. But I want to understand a very big question, a big picture question, which is that on one side there is a drop in yields, brokerages are coming down, commissions are coming down, and on the other side there is a fear from startups which are eating market share. Even though the pie is growing, there is a change in terms of their approach and aggression. How are you coping up with both these factors?
Well, I think that's a question, and that's a game that we are playing every day in the market, and it's not recent. In fact, it's been going on for a while now. It's been going on for the last few years. So really, how are we approaching this? I think one needs to understand and get behind and get into the skin of the customer. And one clearly finds that there are different categories of customers, and each category of customer or each cohort of customer has got a very specific need set when he comes to the markets. And at the end of the day, everyone comes there either to make wealth or protect their wealth and grow their wealth. And I think that's the fundamental need of every investor. So what we've been doing is we've been rapidly innovating, coming out with propositions which connects with different cohorts of investors. And that is a differentiation that we've been able to bring about. Some of the propositions we brought about have got very well received. The liquidity proposition in form of Prime, where you get instant liquidity, for instance, that's connected well. Research-backed inputs that we provide, enabling clients to maximize their wealth journey. That's something that our investors like. So it is about bringing the right kind of proposition, be it in terms of pricing, be it in terms of value, be it in terms of research, be it in terms of liquidity. And we've been looking at it in a holistic manner and targeting our customers in the right manner. The other leg, which has been very extensively used by us, is the massive digitization capability that is possible. I think customer experiences, customer journeys are very, very paramount and important, and we've invested a hell of a lot in that space, and we continue to invest more and more in that area. So it's, I suppose, a combination of good experience, caring about what the customer really wants, and giving him the right proposition. And it's an ongoing journey, to my mind.
Hi, Vijay. Great to have you here. I think this is a very exciting time for this business. On one hand, we are seeing a very rapid adoption of new clients coming onto the platforms. There is you should be feeling like Hindustan Lever in the early 80s, where they suddenly saw a massive rural market and a massive need, opportunity in penetration. But if I'm going to ask you two questions, the popular belief and feeling that people have is that, look, COVID was a very unique crisis which got people to sit at home. They couldn't move out. And therefore, one of the things, and, maybe the businesses were shut, they had their savings or they had their working capital money in the business. And it was very easy for them to sit down and start trading and investing in stocks. And that we saw a massive bump in volumes and new customer additions. And once the COVID wave recedes and people get back to their normal lives, they get back to their offices, back to their businesses, this growth will not sustain, right? It's very important to understand your view on whether you think that this is a far bigger sustainable trend, or it is a huge bump that we've got and then things will go back to normal, right? It's like demonetization. Suddenly, because of demonetization, there was a huge spike in digital transactions. And then digital transactions tailed off a little bit, though as a percentage of total transactions, digital transactions keep going up. But we saw a massive peak, a fall, and then we saw a steady rise. How do you see the situation? Sitting from where you are at your vantage point, will be very interesting to understand.
Thank you very much. I think you raised a question that we've been asking ourselves as well through this last few quarters of pandemic that we've experienced. And to be honest, I would say that my thoughts on this has gradually been evolving as I've been thinking and observing the marketplace. So let me share how we've been thinking about this. The point when had you asked me this question maybe 4-5 months back, my answer would have been around what you sort of alluded to in your question itself. That yes, there has been a surge up on account of various factors, which includes the factors that you brought out in terms of simply availability. But it's also to do with certain further enabling facts, which is the competing markets, be it the fixed income market or be it the mutual fund industry, had a very tepid, lukewarm sort of attraction to these investors. So more money flowing in there, added perhaps to this whole wave. And let's not forget India's penetration into financial markets, particularly equity markets, is abysmally low. So in a way, it is a trend waiting to catch up with what happens as India goes through its own economic journey. It has got to start someday. Perhaps the pandemic has sort of in a way triggered that kind of a journey in that direction at an accelerated pace. But that apart, and therefore, keeping these factors in mind, the thought that was emerging at that point, maybe a few months back, was that whenever there is an episodic sort of a surge, you gave the example of demonetization. And, there was another period when the government came in with a large majority in 14, and then again there was an episodic surge after that. We found that in the last 10 years, there have been at least these two episodes, the one that I just explained and the demon. And in both the instances, when we saw how the wave sort of moved post-pandemic, we saw increase in interest through that episode. And then there was a bit of a wave and it settled into a new normal and then resumed its organic growth. That was the kind of behavior we've seen in both these instances. So I was inclined to believe that, perhaps something similar should happen even now, once the episode of the pandemic sort of abates. As I've been thinking about it, there is a new perspective that is emerging, and I'll just share that with you. We find that a new generation of Indians are coming into the market. And when you think about it, I'm talking about the generation born in, let's say, the early to mid 90s. We call them, the younger millennials, not even the regular millennials, the younger millennials, and perhaps the Gen Z. Now, these Indians are coming into what one would call economic India. They are turning, let's say, 23, 24, 25, 26. And that's broadly the age in which they start earning. Now, if you look at the persona of this cohort, which is coming into economic India, the persona of this Indian is an Indian born with a mobile handset in their hand, virtually. They've grown differently, they are wired differently, they are inspired differently, their buying motivations are very different. If I have to sort of put it in one or two words, I would call them digital natives. One is being digitally savvy, but there's something beyond that, and that's a digital native. That's the way they work. Now, if you're talking of
right, Vijay, it's such a great point. Vijay, it's such a great point. I'm afraid, we've just run out of time. I must admit it honestly that we've genuinely run out of time. But like Vijay said, that the new generation has a smartphone. Well, I have a smartphone. Two advantages of having a smartphone. You can watch ET now, anywhere, and you can trade and invest on the platforms anywhere. So really appreciate your time, gentlemen. Thank you for being part of the big picture. Hiren, look forward to many more engagements. Vijay, thank you for being part of the show. We'll take a break. When we come back, it's Fortis. The turnaround in Fortis for the quarter gone by was nothing short of magical. Well, will it continue? More on that with the management.